Welcome to the Property Profits Real Estate Podcast, the show where real estate investors talk strategy, capital, deals, and growth with your host, Dave Dubeau.
Hey, boys and girls, welcome back to another great episode. Today, our special guest is zooming in from just down the road from me. He's based in Seattle, Washington, but most of his deals are in Houston, Texas. We've got Mark Shuler, who is a very accomplished and experienced real estate entrepreneur. I believe, Mark, you've got over 4,000 units in the portfolio, multiple different communities, vertically integrated company. So, Mark Shuler, welcome to the show. Great to have you.
Oh, thanks for having me. Appreciate it.
SGRE Investments. First things first, what does SGRE stand for?
Shuler Group Real Equity.
Well, there you go. That makes sense. So, Mark, maybe tell us a little bit. I mean, I know your background is you're an architect by trade.
Yeah.
So just big picture, what kind of sparked the interest and the passion to get into not just designing pretty buildings, but owning multifamily properties?
Oh boy, it's been a long journey. As a kid, I was hardwired to be an architect. I mean, I just displayed a real acuity for it, and I was forever designing and building things. And by the time I got to high school, it was really evident. And then I went to university and did my undergrad, and then professional education, came out and started practicing. And I've been a prolific practitioner. I still practice. I do on average 10 projects a year, big projects, and I actually still really enjoy it. It's still fun for me. A lot of guys at my age are looking for the exit, but I figured out a way to monetize a hobby, basically.
Yeah, that's big. Plus, who the heck wants to just sit around twiddling their thumbs anyhow, right?
Beats beating a reader at Walmart, so it's a lot more lucrative.
So what sparked the whole interest in owning apartment buildings?
Well, along the way, obviously, I had a lot of developer clients.
Yeah.
And, I was just looking over their shoulders and looking at them and looking at the project I was working on for them, and realized pretty early that I was making them a lot of money and I was hardly being compensated for my efforts. And
you saw a little discrepancy in the check sizes, huh?
Yeah. And so quickly realized that these clowns could do it. I know I could do it and probably do it better. But in all seriousness, there's a lot of risk involved. They're doing their job, really. They're trying to mitigate cost and expense. And I figured that out after a minute. It's like, okay, I can't fault them for doing their job.
So when did you start getting actively involved in real estate?
Well, I went back to school, believe it or not. I went to business school at the age of 48.
Mm-hmm.
Went back to school, did a 9-month executive program in commercial real estate.
Mm.
And then, that was in 2002-ish. And by, 10 years later or so, 12 years later, I started doing deals. And I've been a housing guy my whole career. So the apartment game was a real natural pivot for me. So I got into apartments. The other thing is I'm in the family business. So everybody in my family is in real estate, one way or another. I have 5 brothers and nephews who are commercial brokers.
Oh, wow. Okay.
And my kid brother just retired, but he was the foremost authority on real estate taxation in the country while he was working.
Well, you're well connected.
Yeah. And so it's in my DNA.
Yeah. So fast forward to now to 2026. What does the portfolio currently consist of, Mark?
We've got 4,200 units under management. I still have a 40 unit in Seattle that I kind of waiting for the market to turn so I can sell it. But the vast majority of those are in Houston. And it's on about 15 campuses spread around inside the outer loop metro area.
So 15 campuses, what do you mean by that?
Well, these, 550 unit.
Okay. Yeah. 15
garden style complexes, they're usually 2-story buildings spread over about 8, 9, 10 acres.
Got it.
And I just call it a campus because that's the way I think about it. But it's a lot of management. It is a ton of management.
Yeah. So you're still doing 10 to 12 architecture projects a year. You got 4,200 units under management. You're vertically integrated. So what does that look like? So what does that mean? What does the team look like?
Good question. So a lot of sponsors, they tend to hire out maybe the management and the construction activity. And so they're paying, retail for all that effort. And getting less than desirable results most of the time.
Right.
After our first deal, we was like, we're never doing this again. So we formed our own management company, and that consists of the leasing side and the construction side.
Okay.
And then we establish vendor relationships all around Houston, and then we control our supply chain from India and China. And so we've got a big warehouse. The product is shipped directly to the Port of Houston, and it's trucked to the warehouse. Our warehouse manager will catalog that, and then we call it, up as we need it for the rehabs out in the field. So
it's
nice. We've got about 200 people on the payroll. It's a pretty large organization.
So when you say we, who are your partners? Who else are you involved in?
I'm involved with a group called Three Pillars Capital in Houston. I am their main capital raiser and, conciliary. I am constantly advising them on construction and design and best practices. I just built in the last 3 weeks a due diligence tracker for distressed assets in Houston. I'm thinking about monetizing that and offering it on a subscription service. But what used to take 45-day due diligence period.
Yeah,
getting to an agreement. I can now do in 45 seconds.
Wow.
Yep.
Maybe there's a little intelligence of the artificial kind helping out in there.
Oh, majorly. And not only that, what's really cool about it is, I loaded up like 2 years of our quarterly reports, all 15 underwritings from our campuses.
Yeah.
The AI is so damn smart now. It accumulates that and continues to learn.
It iterates on it. Yeah.
It iterates on newer and newer. And so I literally, for Houston, I have, bar none, the best intel in the world.
That's fantastic, Mark. So, okay. You guys have built up quite a significant portfolio. I understand kind of what your position is with the team there. Your experience over the last number of years since you've really got active with this, what do you still love about real estate, especially multifamily, and what's not your favorite part of it these days?
I still love the game. If you're an adrenaline junkie, you get into real estate.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
And in the last few years, there's been some adrenaline hits.
It cuts both ways, right? But here's what I usually tell people: you don't get in for the money. If you get in for the money, you're going to be sorely disappointed. You can, and I have built substantial wealth doing this, but the ROI and my time commitment and the stress, sleepless nights, being an operator, it is not for the faint of heart. You've got to have some real chops to be able to succeed in this business. And too many people from the last few years, and let's just go right into it, got into the business without any operational understanding. Specifically, a lot of finance guys from New York came into the business thinking, it's so easy to make money. That's when we were in a low interest rate environment and cap rates kept trending up because there was so much demand for a limited supply of product. In the States and probably in Canada, we're housing constraint, right?
Yep.
We cannot build enough housing to keep up with the demand. And there are a lot of reasons why that exists. I don't want to go into that now, but the short answer is the regulatory environment is too robust, and we cannot build enough housing to keep up with the demand. And so what that does is it kept pushing value north because we were in a bubble. In hindsight's 2020, and we were in a 10-year bubble. The Fed probably shouldn't have held interest rates to near zero. They probably should not have handed out all the pandemic bucks and, flooded the system with all this trillions of dollars of cash. And my tenants were like C-class tenants out buying 70-inch flat screens and new trucks.
Yeah.
It's like, this is very incongruent.
Yeah.
And that it sooner or later had to come home to roost, right? Well, we're paying the price for that right now.
It did. Yeah.
And
so how do you guys weather the storm with that, Mark? How?
It's challenging. I am not going to bullshit you. Right now, it's probably in the last year, it's been the hardest this industry has been in 20 years. It is a constant challenge to my tenants are stressed out financially.
Yeah.
They are, they're doing everything they can to make it happen. Our rents have been flat. In fact, on many of our deals, we've had to kind of go backwards a little bit on our rent growth. And it's going to be flat for the next 18 to 24 months. That's where your operator cred comes in. You have got to be a serious operator in this environment. It is not a game for newbies. And I'm very candid about that. It is really hard. I mean, I'll give you a couple of examples.
Yeah.
The creativity my tenants use to doctor their bank statements, if they even have a bank that they utilize, or their income statements, or their any other documents we require, knows no limit.
Wow. So they're using AI to generate BS documentation.
Yeah, you got it. And so what I'm doing is now using AI to scan for that. And I will tell you, retention is a much better game than new leasing.
So it used to be new leasing. You wanted to churn so you could crank up the rents.
You don't want to do that now. You want to retain.
Back to the traditional, keep them as long as you can.
Yeah. And our rejection rate now is over 40%.
Because there's just so many people are BS.
Yep. Wow. Yep. And so, I was just on a podcast this morning. We were talking at length about this. I wrote a really good LinkedIn post about this the other day. I would rather sit vacant for an extra month than get some. And what a lot of these tenants are doing, I should add, there's a lot of concessions going on across the country, right? 2 months, 3 months free. They're couch surfing for the concessions. Yep.
What do you mean?
Meaning they'll get in for 3 months and then not pay their rent. And it takes me 6 to 8 months to get them out of the unit.
Yeah. Even in Texas.
It's a lot shorter in there. In Seattle, that is...
Oh, yeah. No,
that's years to get them out. I've had tenants squat in my buildings for 4 years.
Oh, my God. Yeah.
Yeah. So, but look, the point being is I'd rather nip it in the bud on the front end. Yeah. And not lease the unit to somebody who I know and I've identified as being, potentially a bad tenant.
Oh, definitely.
Then go through that grief. Now I've got
okay. So there's lost.
I've got that lost income.
What's that?
Let me say I've got that lost income.
Yeah.
Plus now a turn.
Yeah. Exactly. Plus whatever. All the damage they.
Yep. Legal expenses to go after them. It's not worth it.
No, it's not. You're absolutely right. No tenant is better than a bad tenant all day long.
Yeah.
So, Mark, I've spoken to a few other operators, kind of like yourself, same kind of experience level, and some of them are very bullish now on the market, saying they're starting to, it sucks operationally, it's challenging, but now prices are getting better, a little bit more reasonable. Deals are starting to make a lot more sense financially. Some of them are very, very bullish about this. What are you guys' thoughts about? Acquisitions over the next couple of years?
Well, funny you should mention that. I am preparing.
Mm-hmm.
So a lot of deals got done in 20, 21, 22, right?
Yeah.
Those loans are maturing. And they have not created enough value to justify a refinance. In fact, many of them are underwater, less than a 1.0 debt coverage ratio.
Yeah.
And that's a receivership deal right there. There's about $1.8 trillion worth of multifamily out there that's going into foreclosure.
Really? Wow.
Yep, over the next 2 years. Read about, Blackstone, BlackRock. What's the other one? Is it Abbott or Cord? I can't remember. There's another big multifamily operator. They have lined up hundreds of billions of dollars to take down all these deals. And they're picking them up for I know one operator, he got a 2025 build that was 5% occupied.
Wow.
The build cost on it was $270,000 a door. He made an offer of $130 a door and it got accepted.
My goodness.
That is a legacy asset that he will never sell. He'll just run it 5 years and refi and pull cash out.
Yeah.
So there's going to be a lot of those deals. And look, the big boys they're going to come in and buy everything. But what I'm hoping to do is catch falling knives.
Yeah.
And, pick up about 6-8 deals. And, so that's what I'm getting ready for. I have been talking with a lot of institutional capital. Right now, I'm talking about $500 million worth of capital that could be deployed with me. We'll see. Talk is cheap. Same time, I'm still trying to find all the LP investors I can find because you are exactly right. There's going to be some real opportunity in the next 2 years.
Yeah.
Like a generational opportunity that we haven't seen, not even since I've been in the industry.
Wow. Yeah, that's exciting stuff.
Yeah.
Well, Mark, I'm glad that you guys have made it through the poop storm that everybody's been going through this couple of years.
Kindly put.
Yeah. I'm not all that eloquent, but it gets to the point. It's challenging times, but I'm also glad that you're still, excited about this. You're motivated by this. You've taken some licks, but you keep on ticking. You've learned a lot. So I'm sure there's going to be some people watching or listening to this who'd like to connect with you. What's the best way for folks to do that?
Yeah, you can just kind of reach out to that address right there, sgreinvestments.com. I'm in front of the box all day long. I generally respond within 3 minutes or so. And love to talk about this. I still, after all this time, find it to be a really fascinating industry. And I enjoy it. It's tough, but we're going to grind through them just fine. So
awesome. Mark, it's been a real pleasure. Thanks for being on the show.
I appreciate it. Thank you.
Everybody, thanks for tuning in. We'll see you on the next one.
Thanks for listening to the Property Profits Podcast. If you'd like to be a guest on the show, apply at daveinterviews.com.